Well, hello everyone. This is Chris Kimble with Kimble Charting Solutions, and thank you for the opportunity. I know all of you are very busy of sharing some time today. Speaking of what today is I want to wish you happy Valentine's Day while we're looking at the disclosure statement that many of us have to share. But I want to get moving with the presentation and appreciate the opportunity today. One thing I just kind of want to say as far as our shop at Kimble Charting Solutions, this is my 37th year, and we try to maintain this symbol as somewhat our philosophy, in that I don't believe that you should be bullish or bearish, either one. I know that we are not on any certain product. We're just looking for solutions and opportunities, and like I said, this is my 37th year in the business, and I don't think the opportunities to me have ever been more exciting or more various and varied than what we see right now. One of the things I was lucky to do was have a friend and a mentor by the name of Sir John Templeton, and I promised Sir John that I would continue to bring this up for as long as I could fog a mirror. He had said outside of the Bible, the investment book that he had learned the most from was this book that you see on the screen, and it is a long title. Many of you have probably heard of it, but it's called The Extraordinary Popular Delusions and the Madness of Crowds by Charles Mackay. Just a little FYI, this book was written a few hundred years ago, and after Sir John told me that, I was kind of a little disappointed to hear that this book was as old as it was. But John just made the case, and I really appreciate it a lot more now than when he shared this with me, 21 years ago, that even though this book is old, it's still accurate because it's based upon sentiment and crowd behavior. And when I shared that I was disappointed that this book was so old, and this was in what I thought was the roaring 90s, and I thought we knew a lot about technology then, he just said, Chris, if we were alive 200 to 300 to 400 years from now, he thought the book would still apply because many investment decisions would still be driven by emotions. So this book's easy to get now on Amazon, and I'd encourage any of you or all of you to read this book if you get a chance, and I can promise you it'll really change some perspectives of how you see the news in a real opportunistic way. One of the things that I didn't really appreciate at the time, this is a picture of Sir John, and if you hear of the Franklin Templeton Funds, Sir John was the founder of the Templeton Funds. And I got into the business in 1980 straight out of college, right here where this arrow was, and obviously it was a lucky time frame, but from an investment perspective, I remember getting my securities license that, when the Dow was at 1,000 in the mid-60s, and here we're still at 1,000 15 years later, you can understand that people weren't very excited about investments. The easiest choice was to run down to the bank. You could get a CD at the time, and you could get it for around 15%. Short-term rates were extremely high, and you got a free toaster with it. And I couldn't offer either of those. But you can see from this chart is from the Ridex company, from a long-term perspective, that was a pretty decent time frame to invest. Valuations were very low to moderate, some of the lower in history, and it was ready to embark on a huge bull market that I had no idea would be as big as what it is. But he talked to me in the late 90s, and he made a case and made this statement. He said, Chris, I believe that at best the markets will be flat 15, 18 years from now. He cited several reasons, and this second arrow came in. One of the things that got my attention is Sir John, as he has passed away, but he was always a great optimist. And he remained optimistic in 1999, but when you get to looking at his positions, you can see he had concerns for the market, and he had at that time shorted every dot-com stock that he could get his hands on. So he was pretty much the pioneer of international investing, and in a way I think he was the pioneer of shorting dot-coms, because he created in his own way, a mutual fund of all dot-com shorts, and then he also was purchasing zero coupon bonds from the highest quality governments in the world. So if you look at his positioning, you could see he really believed in what he was saying, and he was obviously right on the dot-coms. I believe he closed every position profitable. Many of them went out of business, and the zero coupon bonds, did really well as interest rates fell and bond prices rose. Now, I've been suggesting for people to buy and hold, since I got into the business, And with what he said, really disturbed me. I came back. I've lived in Kansas all my life, and I tried to figure out what to do for my customers and my practice. And so one of the things I was asking myself is, what if Sir John's correct? What do I do? In other words, he didn't think buy and hold would work for a while. What if he was incorrect, because people, even though he was one of the first billionaires in America solely off investing, he's human and he could be wrong. He was extremely humble about things. I was asking myself, can I find a way to eliminate the noise of the world so that I could get non-emotional ideas to help people find important turning points so that I could outperform the broad markets with less risk? I know that's a long sentence, and that's a wish of many of us, but that's what I set out to try to do, especially in light that he said the buy and hold approach would be challenged. And one of the things I want to say, regardless of what I share today, we all know that every strategy has its challenge points or its weak points, and we know that buy and hold is not a broken strategy. But if you don't mind a couple of 50% declines since he said that, it's the perfect strategy for you. If you'd like to avoid some of those declines, maybe there's an alternative. So one of the things that then we came up with was the idea of the power of the pattern, and you can see that all of these patterns are taking place in nature, and it continues to amaze me 37 years later how many of these patterns that are similar to these flowers and vegetables also take place in our marketplace. So we've been publishing or been a publishing company for the last 7 years, and we publish research. We'll see later on, Rick will tell you a few details about our company, but we publish research on a daily and weekly basis for the last several years. And I've never enjoyed this business more than I do now, and it's a really exciting time. One of the things that we try to believe in is clear, clean, and concise, actionable ideas. This is an example of something that we shared almost 1 year ago near the low in crude. But one of the things that I want to kind of highlight today and how we can take advantage of these emotional swings or the popular delusions book is Sir John made the statement that bull markets are born on pessimism, they grow on skepticism, they mature on optimism, and they die on euphoria. So one of the things that I've tried to focus on is what does pessimism look like from a charting perspective, and also what does euphoria look like as far as that's where it may die. So one of the things that I'd like to just kind of show you, real quickly is something that I've had some fun with is take a look at these two charts, and I'll just share that one of them is from the 1700s and another is from the 2000s. And they have a similar look. Technically wise, you could say, well, maybe there's even a head and shoulders top in each of them. But the chart on the right is from the 1700s. It's discussed in the Popular Delusions book. This is a chart of the South Sea bubble. And we all know of Sir Isaac Newton as far as being labeled the father of, the inventor or publisher of gravity. But I think it was a sad story. He really found out a ton, maybe even more about financial gravity, that he invested the majority of his family assets at this price point, and he sold the majority of it down here, and he lost 90% of his money in just a few years. So this chart on the left is actually the Dow Jones Home Construction Index, and as I was on an airplane several years ago in 2006, I picked up a USA Today newspaper at the airport, and it said that 50% of new home sales were second homes. And I have to humbly say that if we were second home sales, I have to humbly say without the Popular Delusions book, I don't know that headline would have jumped out at me. But when you get to thinking about it, there was a bubble as far as I hadn't ever seen in my life that half of all of the home sales in America were second homes. And we all know, looking back, that that ended up being a peak, and we know the housing crisis, that followed. So please, if you get a chance to read the book, and you can see that even though we're much more sophisticated even than in the 90s as far as technology-wise, please don't overlook that human emotions drive a lot of decisions, and these emotions, as most of the presenters today that are doing a great job would also suggest that these patterns are nothing more than footprints in the sand, and if you can find repeatable patterns, I mean, here's a good example of something several hundred years later that looks alike. So one of the things we also talk about is to our customers that we've been sharing for a few years are what we call Eiffel Tower patterns, that a lot of people talk about a parabolic move, but we try to think of it as the Eiffel Tower, that if you see the left side of the Eiffel Tower, you often can experience the right side of the Eiffel Tower. So please have technical knowledge, be aware of it, and also know where the exit door is in case one of these patterns is staring you in the face. So what we want to talk about today is we're going to share some ideas for long, intermediate, and short-term traders, and we're going to discuss emotional clusters. You know that when you think about what we started out earlier, that bull markets are born on what? They're born on pessimism, they die on euphoria. How can we find some of those extreme price points? So we're going to look back on some of the past, where we are here and now, and then the bright future I feel that we have ahead of us. So the first step to me in finding what we want to call emotive points is we say that you should start long and smooth. In other words, look for monthly charts that are line charts so that you can have a long-term perspective and something that's very smooth so you can find these potential emotive points. This is a chart that we shared earlier, and we started producing this a year ago. This is crude oil. Again, this is long and smooth. This is the crude oil chart going back over 3 decades on a monthly closing basis. And we were sharing this with our customers a year ago, that when you took several, as we all know from a charting perspective, if you have a monthly reversal point, say like down here in 1986 or 1993, that this is on a monthly basis, that if you start speeding this chart up, in other words, converting monthly to weekly, you may find all the more potential reversals in this. But again, we're trying to go long and smooth. Well, a year ago when the market was falling apart and crude oil was collapsing, it was very easy to hear talk that crude oil, was going from $30 down to 20 or even lower. The world was, the sky was falling and imploding. And we were making the case that these emotive points, that several of them, because everyone, we could have drawn this chart in 2002 and just had it sitting out there, because that was the last emotive point that would have been touched in 2002 or 3, and it's still always amazes me to this day that this price point here in February last year, again everybody, in February 2016, ended up being a great reversal price point. And so this applies to longer, intermediate, and short-term traders in finding key emotive points like this. Another one, is an example of how you can use long-term charts to help make short-term decisions. On September the 1st of 2001, with the use of the power of the pattern, this is a copy of our blog post that we felt like the Swiss franc, which seems to have influence in a correlative way to gold, that the Swiss franc was up against 30-year resistance, and most of the times that this resistance line had been hit, gold had been flat to down for years to come. So we just made the case in 2011, why not the same thing happening again? And I know at the time it was hard for me to believe, but from a power of the pattern perspective, it wasn't hard to believe. Plus gold had been up, 10 years in a row going into that. So I think I chose this person yelling into the phone in the upper left of the chart because I know at the time there was a lot of people that said, Chris, no way that could happen. And that from 2011 to now, gold and the metals are great products, but the buy and hold concept has really not been the best thing or strategy to use for those assets. So I just kind of want to show you how we can build some of these charts. This is the Swiss franc, and again, we're really from a 30,000-foot view. This is a chart that goes back into the 70s. So each of these high points that we call, instead of emoticons or emotive points, they're emotional points. I don't care about the news that's driving these things. We don't trade on news or events, something like that. But we do try to tie these points together. And so what we try to look for are what we call clusters. Can we tie emotional highs and lows together to where they can reach a certain apex or a common point in price and time? So this is where we made the comment, or what made me feel more confident of making the case that gold should struggle for years to come back in 2011. This was obviously an emotional cluster in play. So here's what gold looked like at the time. One of the interesting points was if you went back to the high of what many people call the Hunt Brothers high, the potential, was a lot of finger pointing of manipulation in the silver market in 1980. But if we just took the 80 high on a monthly basis and the 1999 low, and now we're getting into repetitive patterns, the power of the pattern coming to be, and we just applied Fibonacci to it in the 161 level, or 261 level, excuse me, lo and behold, after 10 straight years up in the metals, we saw the Franc hitting a 30-year line. Gold was hitting this 261 level at the top of this trading range. So there was a lot of pieces that fall into play when we go to try to make a case or to make a statement like that, and luck never hurts. And so we were very lucky to make that case, and for our members we were participating in the metals, and then we walked away, and after time we ended up even shorting silver. So this was just a price point, another piece of evidence why we wanted to walk away from metals. So from our criteria, gold's highly correlated with the Franc. The Franc's hitting a resistance cluster. Gold was hitting 10-year resistance. It was up 10 years in a row. You had a 261 fib level in play based upon the 1980 highs and the 1999 lows. And then we can see the results after that. So here's another look of a chart. There's not going to be a name on this chart for a while. I believe that we're all human and we have biases. So what we try to look for is first, to try to find tops, we look for bottoms. So we look for bull markets are born on pessimism. So you can see whatever this chart is, it's over a decade in length. You see rising lows, then you create a parallel line to that. And you can see that somewhere right up in here last year, it was hitting this for potentially the 4th time. Also, some other resistance was coming in. Relative momentum is important to us. So you can see that it was lofty. We also took this high and low as it was touching the top of this channel and the bottom, and applied the 161 Fibonacci extension levels to that. At the time, 90% of the people were bullish this asset in the summer of 2016. And if you're wondering what this asset is that was TLT. And so we shorted TLT here, and then you see the experience that it had, after that. So we try to make this, so this is an opportunity from a long-term perspective. If you are long bonds, it'd be a place to do what? This easiest move is to pull up some stops. The next one is to possibly harvest and take some profits. If you're more flexible and looking for inflection or reversal points, this was an ideal opportunity. We felt like to take a short in TLT by buying TBF. You could have bought TBT, the 2X. We just bought the 1X, at this price point. So these are different ways that we're trying to help people on a short and long-term basis, examples of that. And then following this apex of euphoria, we would want to say, TLT experiences one of its largest 20-week declines in all of history. So that's the past. I want to share with you kind of some here and now, things that we're excited about. So I'm not going to draw any more charts in the interest in time. I'm going to show you them completed with emotional clusters. But this is an example of the US dollar gold ratio going back almost 30 years. And so you can see recently, I know you can't tell exactly what date that was, but this ratio was kissing the underside of several resistance lines, and so it was a great place. When this ratio falls, it means that gold is stronger than the dollar. Then the dollar has been stronger than gold for several years, and it's kissing the underside of resistance. And so in a minute, we'll share with you how we played that in the metals market. But here was a resistance cluster that we were very excited about. That this took place, everybody, around Christmas. So this is not very old of a chart from not much action has taken place since this cluster was hit. At the same time, this is a chart on the S&P 500 and the gold bugs ratio. So it would be XPX/HUI. And right here at this price point was another cluster of resistance. There's a possibility of a head and shoulders top, you can see. And at this price point, we'll just show another chart we went long GDXJ. We wanted to try to get as much alpha on our trade as possible without using any leverage, and so that's why we chose GDXJ over GDX. Since that time, we purchased GDXJ on December the 27th. That was the first business day after Christmas. And we all know that the market, whether it's the Dow, the S&P, many indices are at all-time highs. But since we're almost 2 months, I think, what are we, roughly 7 weeks out. But since that time, GDXJ is up 45%, and the S&P is up about 3%. So not bad for the S&P, gaining a little bit over around 1.5% a month. If it could do that for an entire year, that's obviously a great gain. But I'm kind of surprised, everyone, that a lot of the indices are getting a lot of attention in America, and the opportunities like this, I think, were missed by most. And so this has been a really good trade for us. So we've started selling into strength and bringing up our stops on our GDXJ position. One of the things that I think is, you know, in 2011 we shared that we thought metals could fall for years to come. This falling channel that's shaded in pink, the channel 1, is the silver-gold ratio, which is SLV/GLD. One thing that we've been sharing each week for several years with our members is we're wanting to see this ratio provide strength, so that if it does, it would provide a message, a positive message towards the metals complex. And so this is a chart that's updated through today, and you can see that at the number 2, this the SLV-GLD ratio is testing channel resistance. Now, this is an ideal opportunity for metals to let people down. If you're a bull, to let people down again, because it's just done it over and over for years. But on the flip side of that, everyone, could this be a bull flag? You know, time will tell. But the point being is, if it can break out at 2, that would be a breakout of this falling channel that's taken place in 6 years. If it would take place, it would send a positive risk-on message to both gold and silver. So to me, this is one we've really been watching close, and obviously it's testing, pushing, trying to see if it can do something different than it's done for years. Will it be different this time? We're going to see, because it's not going to take too long to probably tell. Another look is the GDXJ GDX ratio. We picked up, like I said, on 1227 right here, as we felt like some support was taking place, and the potential of a multi-year reversal pattern in this ratio. And to be long the minors, you can obviously be long GDX or GDXJ, but if you can get the junior minors to start showing a strength above the senior minors, historically that's been a positive message for this type of a play. So this, similar to SLV-GLD, is testing multi-year resistance at the same time. So this, where the arrow is, could be the neckline of this. It's testing the underside, and so for right now, everyone, this is resistance as the trend is down, creating a series of lower highs and lower lows over the years. But if this would break out, it would obviously be a first in many years and would send a positive risk-on message to both GDX and GDXJ. So some emotional clusters that I'm really excited about as far as bright future trading opportunities, is the first one here is the bank index. We know that banks have done well since the election. We're not about reasons why, but the thing that intrigues me here is that there's 2 long-term channels that, as of just this week, that is attempting to break out at the blue arrow above. So even though banks have done really well, they're making an attempt to break above dual resistance. So whether you're a long-term trader or not even a trader, just a long-term investor, banks are still below the 2007 high, as you can see, but they're working on a dual breakout, which is a positive risk-on message from the banks if strength continues here. One of the things that you know, when you think back over the last 4 or 5 years, if you were to think of a general asset class that's done poorly, what might come to your mind. And one of the things that comes to my mind is just, from a general perspective, is commodities. And so one of the currencies around the world that has a pretty fair high correlation with commodities is the Aussie dollar. And so this is a weekly chart on the Aussie dollar going back, the last 17 or 18 years. It peaked in 2011 up here and remains in a solid downtrend, and it still is, but it is testing the upper band of this falling channel. And I think it's interesting if you look up here, see how this pattern looks with this support line, and you can see this series of lower highs. You can almost see the polar opposite of that pattern taking place here. So you hit a cluster of support. So a big test is going on for the Aussie dollar of a potential dual breakout. And again, right now, still in a downtrend. It hasn't proven that it's in an uptrend. But if you would have a breakout at this price point, which is at the current levels at almost 77, that would send a positive message to the Aussie dollar. So traders or investors could be long the Aussie. An ETF play would be FXA. But what I'm most interested in is if we would see a breakout here, it would send a positive message to many different commodities. So another take is on the flip side of that is the US dollar. And as most of you know, is typically when the dollar is strong, commodities struggle. And so you can see that the dollar has created, this is a weekly chart going back 30 years, the dollar has created a series of higher lows, but once it made this final low in 2011, as it has rallied, then the commodity sector, we could almost flip this chart or stand on our head and invert it, has been weak. So the dollar remains in an uptrend, but the 100 level is really key as far as two different fib 61 and a 161 resistance level come into play. You can see that the dollar, if we draw a line across here, did test 100. It used to be resistance, and it's tested it as support. The dollar is a little bit above 100, I believe, right now. But what happens here is going to be key and going to drive a lot of portfolio construction for all of us, whether you're a short, long, or intermediate trader. Another currency similar to the Aussie dollar that we believe is really critical to watch is the Canadian dollar. So this is the US Canadian dollar long-term chart, again going back 30 years. So when this is falling, commodities are doing well. When this is rising, commodities are struggling. So the bottom line is the US dollar has been stronger than Canadian dollar since 2011. So commodities peaked here and they've fallen since. But there's a potential that that we see a long-term reversal or a head and shoulders top taking place right up here. And a key support level is being tested just as we speak right now. And so if we would see continued Canadian dollar strength or US dollar Canadian weakness, this would be a positive sign for the commodity sector. And we all know, and I'm not going to fall into that argument or debate on our policies from a new administration reflecting economic strength or inflation. Hey, humble everybody, that's above my pay grade. I really want to specialize in looking at price patterns, and the bottom line is if this would fall here, the positive ripple effect would be is that several different commodities could do well that have really struggled for years and years. This is the Thomson Reuters Commodity Index. We started sharing here in the summer of 2014 that this looked like a long-term topping process and that we were at the right shoulder in 2014. And since then we've seen one of the more dramatic declines in commodities. Some people have said that not even since the Depression have commodities been down 6 calendar years in a row, which has taken place. But there is a potential that you can see here that maybe a long-term bottoming process or inverted head and shoulders has taken place. But right now, heavy resistance is in play, right here, as a triple or a cluster of resistance is in play. So I would behoove you to keep track of this index or other favorite CRB indices, because this is a big test. And again, this is a monthly chart so far this month, which is not obviously halfway over. There's a little bit of a bearish wick or a reversal pattern taking place at resistance. But from a short, intermediate, or long-term trader, what takes place here should really impact your understanding of the inflation-deflationary story. This has been a deflationary chart that's been taking place. We have a counter-trend move, and this is going to be so big for many of us. I'll share my bias that I know hope is not a strategy, but I hope this breaks out, because if it doesn't, then you're going to want to be short commodities, and it would suggest that we just had a counter-trend rally in a deflationary decline, and that deflation would pick up speed to the downside big. And so I would like to not see that be the thing for all of us, but from a trading perspective, we're open-minded to either way, because we're not bullish or bearish. This. I'm just saying from a big picture perspective, it'd kind of be nice to see a little bit of all this money printing actually create some growth. So I apologize that we just looked at this chart earlier, but I think it's just a message of how important to me that this is. Again, this is the bank index making an attempt to break out of dual resistance. Many bull markets in history have needed, wanted, and experienced banks going along for the ride. And as you can see, banks are attempting this push-up just this week. A little new strength of the bank after traveling sideways for several weeks is taking place. So from a risk-on message, this is a unique situation that would be taking place in the BKX index, XLF, or also you might want to take a look at the regional banks, KRE. So I'm going to stop at this time and just say a big thanks to all of you on today's call, and I'm going to turn the call over to Rick Pitino just to explain some of the things that we do at Kimble Charting Solutions, and we're going to have a special offer for everyone on the call today. So I'm going to see if I can switch this over to Rick. Rick, are you there?
I'm here. Can you hear me?
Yes, sir.
All right, so I'm just going to change presenters here on my end. I think I can do that. Let's give it a shot. Hope you like the background. All right, everybody. Very honored to be working with Chris now for 5 years, knowing him for over 10. And providing a perspective I have never seen anywhere else duplicated, and we hope that the work that he does just gives you a different perspective. There's lots of guys that do charting and do some great charting, but he is one of the most unique in terms of the type of pattern analysis, and our goal is to help you make better decisions, not to be the be-all, end-all only solution for you, but to be research that if you add it, can help you improve decision-making and results. So very happy to have you here. Thank you, and I'm just going to cover two quick things with you today. First is kind of a summary of what we're trying to do to help people. Number one, get this out of the window if you could see that. Number one is identify key market turning points and breakouts, which you could see with all the charts that Chris showed. That's without a doubt one of the number one objectives we have. We call it TB&M, tops, bottoms, no middles, truly trying to get the extreme situation for you to capitalize on. The other thing is lots of news. Forget just Trump aside, there's a ton of news out there, and it makes it more difficult when you're trying to make good, solid investment decisions. We try to focus on charting to help us to do that, but also even in charting, got to keep it clear, concise, actionable. That's our number one goal with the charts, and not make them busy. Even then, if you make them busy, it could make decision-making difficult. So we want to try to simplify that, help you focus on making that decision that's going to make you money at the lowest level of risk possible. Give you another set of eyes. We truly want to be another set of eyes for you. All of us are busy. If you're doing your own charting, there's only so many things you can look at. If you're not doing any charting, obviously it makes it very difficult to look for opportunities. So we are your set of eyes, if not another set of eyes, to search and alert you to the different opportunities out there. Also, I think we're an approach to charting that improves confidence. You know, if we can show you things at extremes, does that not help you, give you a little bit more confidence to pull the trigger versus, you know, another way to do it, which of course is buying in the middle, because you don't know if that's the point where it's going to turn on you. So buying at extremes, giving you more confidence to pull that trigger, certainly another goal for what we're trying to accomplish. Always nice to know what others think of us, and this is not just about a compliment about Chris and the work that he does and about our company. Those things are nice for us to hear, but what does it mean to you? So what? You know, how does it benefit you? And this comment here, I think, kind of encapsulates that a bit. Keeping it simple, an easy to understand approach, clear information, sharing how it can be used, and bottom line, profitable trades. Very simple from Michael, long-term customer of ours, and very clearly put in terms of the kind of benefits that he has seen from what we're trying to provide to members. And another one, and I kind of mentioned this earlier, but from Tom, you know, just the fact that he uses our research to verify his other research is another unique compliment for us, but it's another way for you to look at how to use us. If you have other research, we don't suggest you get rid of it, but rather use ours potentially to help confirm that research. And again, a different way to consider how to use the research as opposed to being the be-all, end-all. We're here to serve you. So on the personal side, you know, there are some things that we try to automate around here to help us remember or not to have to remember to do everything. But if you need us, we're here to talk to you. If you need us, we're here to communicate whatever method is best for you to help you get the most out of that research. The offer today is simple. I put something in your chat box, and we'll go there in just a second, but it's an offer to test drive all of our research. We happen to call it premium, not a new word, but it's all the research Chris produces. It covers lots of asset classes and 50 overall markets, and provide opportunities, trade opportunities on a daily, weekly basis with this research. But what we'd like to do is give you a way to test all of it, and in doing so, well, here's first of all just a snapshot. I forgot a snapshot of positions, just to give you a sense of the kind of assets beyond what Chris shared today, the kind of assets that we will suggest. These are what you're looking at are positions that Chris believed to be at an extreme, have an opportunity to capitalize on, and how he was going to trade them. So these are a position report. This is a position report that you would get weekly. Eventually and soon we're going to make this live, but this is something we share with you, but it gives you an example of some of the types of assets, both ETFs and stocks, that we hold in a premium membership. So test driving premium, what we'd like to do is offer you 30 days free. That's, again, all the research we offer, guys and gals, but it's a way for you to test everything. There's no obligation. You can quit before the 30 days, after the 30 days. You can switch to other research we have, which we do offer individual weekly research. There's a coupon code called PStartFree. Now, this coupon code is actually embedded in a chat message that I just sent to you all, and I'm going to actually go here to our website if I can. Hopefully it'll pull up. Now, in our website, you would put that coupon code right in the browser, hit enter, and what it should do, if it works properly for us, it's going to take us, should take us to a checkout screen. And obviously, well, let's see. You know, you test these things 20 times, and do they work when you want them to? No. It's still thinking. There we go. I knew it worked before. So here's what it's showing you. The coupon code is already applied. The $397 comes off down here, and so for the first month you don't pay a thing. So we don't know each of your situations. $397 might be a lot for some of you. For others, you look at it as an investment, and as long as it pays for itself and you profit beyond that, that it's worth it. But this is a way to test everything for nothing for $30, and then after that it'll go for $397. We also offer discounts, 20% discounts, and 30% discounts on annual and multi-year subscriptions with us. We also have different types of products for you to consider, from individual weekly research to a combination of that at a discount, and then there's the premium again that we were talking about. So just a couple ways to use this. But if you use that link, it should get you to this screen. You would proceed to checkout, and of course, to fill in the traditional information that we need on you to get you started. So that covers the 30 days free and how that all works. I think that covers it. So if you need to connect with us, please do so either by calling us toll-free here direct. There's an email, services at Kimble Charting Solutions, that you can email us, and we'll get back to you with the answers based on your questions, and just would really look forward to working with you and appreciate your time today. I think that covers my take. Chris, is there anything else you wanted to share?
No, Rick, that's great. Thank you, everyone.
Thanks, everyone. Great to have you. Thanks, Renee and Reed, for all you do to help us be part of this as well. Happy Valentine's Day, and we look forward to connecting with you guys soon.